Welcome to the Allan Small Financial Show. Thank you for taking some time out of your busy day to spend it with us. I've been getting a lot of questions recently about interest rates. How high will interest rates go here in Canada? Will the Bank of Canada start raising rates again? How high will interest rates go in the US? Will the Federal Reserve continue to raise rates? And how is this going to affect all of our investment portfolios, the value of our homes, the value of perhaps a new home that's being built? A lot of questions on basically the macro. And we're going to go a long way in today's show to answer a lot of these questions and how the answers affect your portfolio. So let's talk a bit about what's on the show today. We have a nice long list here. The first one is kind of interesting. We always talk in the investment world about different acronyms. Tina has changed her name to Tiara. We've talked about Tina many times. What is Tiara? We'll talk about that right off the top of the show. And then we get into the This Week component. This is where we discuss what's important for individual investors to consider before you make your investment decisions. And we always have 3 bullet points for that as well. We're going to hit on Canadian GDP, Canadian growth. It slumped for the month of December and was actually pretty flat for the last quarter of last year. Surprised a lot of economists. Next thing we're going to discuss are banks need to hike how much they're paying with interest on their savings accounts. We're finding that banks are paying very little interest on savings accounts, but yet they seem to charge more for the loans that they provide. We have an interesting and very powerful chart to show all of you on that. Also, we're going to talk about China. Why is China so important? Well, China is important because it's the second largest economy in the world. And setting a lower growth target, the Chinese are setting a lower growth target. Why is that important? And how is that affecting all of our investments? Lastly, the last topic, does it pay to diversify in today's markets? I had an interesting conversation with a client about a week ago, and they said, Allan, I'm so diversified, but when the market goes down, I still go down. So why bother diversifying? And I said, it's always important to diversify, and I'll explain why. And again, last but not least, your questions. I'll take a few of your questions. Hopefully we can get to 2 or 3. And then if we don't, we can answer those questions either after the show or on the next show. I can address them. So if you have any questions during the show, please feel free to put them in the comment section. And I hope to get to as many as I can. So without further ado, let's get on to the first topic. So here we have Tina has changed her name to Tiara. Quite interesting. Tina for a long time stood for, and still stands for, I guess, there is no alternative. And what does that mean? Very simply, there is no alternative to the stock market. If you're an investor, I guess prior to 2022, or at least midway through 2022, most investors would tell you, if I'm going to invest money today, it has to be in the stock market because interest rates were so low that putting your money in a traditional GIC, a bond, something in the fixed income world just didn't pay enough. It didn't even keep up with inflation, but earning 1-2% really wasn't enough for anything. A lot of seniors, a lot of individuals in general, whether you're older or younger, they use investment vehicles to provide an income for them so that they can use that income to pay their bills. Well, when interest rates are 1-2%, it's just not enough there for you to take home after taxes, of course, if it's outside of an RRSP, to be happy or satisfied. So TINA was an acronym that many individual investors came up with, and that stood for there was no alternative to the stock market. If you wanted to make money, you had to be in the stock market. And I think that's really what drove the stock market over the past decade, that there was no alternative to it. So anytime the market fell, money rushed in and bought up the market. Well, as you can see on the screen, Tina has now become Tiara. There is an alternative reasonable alternative. So there is another reasonable alternative, and that is now the bond market or GIC market. Other than GICs because GICs are not flexible. you buy them, you got to hold till they mature for the most part if you want to get the higher rate. There are cashable GICs, but they pay a lot less than the GICs that you see in the papers or online or you hear about that are paying 4.5%, 5%. Those are non-cashable ones. So there is another reasonable alternative, and that is fixed income, because you can get 4.5%, 5% on low risk bonds, low risk GICs. And that is now competing for investment dollars. You see, when you buy a stock, let's say of a utility, for example, or maybe even some sort of low paying, dividend paying pipeline, paying 4 or 5%. Well, why would you want to take on the risk of owning that stock, that pipeline or telecom, for example, that's paying 4 or 5% dividends when you could get pretty much the same rate if you own something in the low risk area by owning a bond? So many individual investors will say, you know what, I'm going to take my money out of the stock market and put it into the bond market and make the same rate. Now, of course, if you're buying something that's also going to give you growth, that's a different story. But for those that solely are trying to get the best rate or income they can, then now there is an alternative to buying the stock market. There is a reasonable alternative, which is what Tiara stands for, and that is the bond market. So we're seeing the stock market feel the pinch, if you will, kind of feeling as though, well, I was the best and only game in town. Now there's a competitor on the block, and that is the fixed income market. And it has had an effect on the stock market. And as interest rates continue to move higher in the US and here in Canada, although we've seen a pause here for now, but if we move higher again, I think this will definitely compete for investment dollars going forward. However, the last thing I will say is make no mistake about it. Inflation rate is still roughly 6%. So even if you're still making 4.5%, 5% on a bond or GIC, you're still not keeping up with the standard of living or the inflation rate. So if you're looking for growth, I still believe you still need to be in the stock market at some capacity. But definitely, fixed income market is providing another option for everyone's hard-earned dollars today. So this is the part of the show where I talk about what I believe is important for individual investors to consider when you make your investment decisions or before you make your investment decisions. And we like to send these out after the show. We send them out through social media so that everybody can take a look at what I think is important. And we usually set it up with 3 bullet points, and I will elaborate on each. The 3 points you can see right here: economic data. A lot of economic data is being released right now. We saw, or we will see, jobs reports from Canada and the US on Friday. Very important. What's that data going to tell us? Bond yields. Bond yields have been creeping up again in Canada and the US, more so in the US. What does that mean for your money and your investments? And lastly, as I said to start the show, it's all about the macro. And what does that mean for investors? So let's talk about economic data to start. And as I mentioned, we have a jobs report coming out this Friday in the US and in Canada, a very important piece of data for both central banks, Bank of Canada and the Federal Reserve. Probably even more important to all of us, what is the US jobs report? Because as I often say, what happens in the US is far more important to our market, stock market here in Canada and in the US than what the Bank of Canada thinks or does. So what is the jobs report going to look like in the US? And we have a monthly job creation chart for the US that we could show. And you can see here how much the jobs, or how high the jobs creation was for the month of January. Over 500,000 jobs created for the month of January. And you could see how much of an outlier that really was, comparing that to the previous 6 or so months. You can see it was much lower. And that really, I think, has caused or has taken the Fed by surprise. And many people, because of this piece of data and other hotter inflationary data that we've seen since the jobs report, that has caused a lot of people to believe that the Federal Reserve is perhaps thinking about a 50 basis point hike at the next meeting next week. Whereas, I guess prior to the January data, we were thinking they would go maybe just another 25 basis points. So 50 basis points is now on the table. Jobs data goes a long way to give us, I guess, some insight as to how the economy is doing. We also have jobs data in Canada, which we'll show you. And you can see here that jobs data in Canada also was quite high, a bit of an outlier as well. And we could see how there was just a lot of jobs growth in January. And people have been struggling to figure out why that was. A lot of people are pointing to weather, that the weather was a lot nicer and better in the northeastern part of the US and here in southern Ontario, where a lot of people live and go to work every day, and really right across the country. For the most part, it's been, up until recently, I guess, a pretty a nice and mild winter. So a lot of people out and about spending money, creating jobs. And so a lot of people think that that is why we saw such strong job growth. But economic data coming up, we're going to get CPI or inflation data, I believe, coming up in the next week. We this morning got job openings in the United States. We received that data down from about 11 million jobs that were available recently, down to about 10.8. So you figure if you look at the numbers, for every person out of work, there's probably 2 job openings for every 1 person. So that's a little bit higher than the Federal Reserve would want. So that's a key indicator as well. But overall, the jobs and retail sales and inflation data, these are all the things that central banks look at. And right now, it is showing that it's running hotter than what they would like. So keep an eye on economic data as it's released, because that's going to give you an indication on market movement for that day or maybe even that week. The second topic that I think is important for individual investors to consider are bond yields. Now, people are probably wondering, why are bond yields important? Well, again, as I spoke about earlier with respect to Tiara, there is a reasonable alternative, and that's the bond market. As bond yields rise, and they've been rising significantly in the US, that is never a good thing for the stock market. And again, we have a few charts, the 10-year Treasury chart that we'll show you, showing that the 10-year bond rate is now approaching 4% once again. Interesting, though, the last time it was up, it was 4% back last year, towards the fall of last year. Stock market struggled mightily. It couldn't get around this idea that the 10-year could be at 4%, the 2-year could be at 4.5, 4.6, which was where it was. Today, the 2-year is all the way up near 5% in the US. So the market tends to struggle when interest rates are higher. Again, interest rates are higher, cost of borrowing is higher. There's another alternative for individuals, dollars, hard-earned money, to go out of the markets and into fixed income. So whenever you see bond yields rise, it's never a good thing. And I think we have one more chart here. You can see a graph on all the different types of Treasury yields. Here you have the 3-month. What we like to look at, if you take a look at the 2-year, you can see the yields around 5%. You'll look at that, you compare that to the 30-year. What is that, 3.5-ish in that range, 3.5, 4% right now. So you can see, again, the yield curve is what we call inverted. You would think 30-year bond would pay higher interest than a 2-year bond, but it's not. The 10-year is not paying as high as the 2-year either. And that is a function of how quickly and what the Federal Reserve has done over the past year. Raising rates quickly has caused the 2-year to spike. The 10-year, the 30-year is moving higher, but not at the same pace. And that, unfortunately, is never a good thing and usually spells some sort of recession down the road. So investors need to look at bond yields before they make their investment decisions. Lastly, it's all about the macro. And I bring up this topic because I've been getting questions about, what about this stock, Allan? You tell me to buy this stock and it's struggling, yet you're confident that at some point it will go higher. And we have a chart about key interest rates, which we can pull up here as well as I speak. And you can see that individual stocks are struggling, but not necessarily because of how their business is doing. Take a name like Salesforce, reported fantastic earnings last quarter, and they just reported earnings within the last week. Blowout numbers. The stock has basically shot up significantly, but in the last few days, today included, it's sort of muted and even down a little bit. Why? Because the talk is back on the table about higher interest rates for longer and even higher than we expected. We were anticipating in the US, maybe rates get to 4.5, 5. That changed to 5, 5.25. Now people are talking about 5.5, 6% that rates can get up to. So it's no wonder that stocks are struggling. And you can see here how quickly, both in Canada and the US, interest rates have gone up. It's almost a vertical line. It is almost a straight line higher. And at some point, well, we've already seen a pause in Canada. We hope that pause stays in place for quite a while and eventually we see interest rates falling. But in the US, they continue to want to raise rates. The Fed has already told us they're going to raise rates at the next meeting. They've also indicated they may even go higher, maybe 50 points instead of 25. So keep that in mind. When I tell you or someone recommends a stock or I recommend a stock to an investor and that stock may fall, it may not be because that individual investment is struggling or that company is struggling. It's all about the macro right now. Individual names will struggle when the macro provides an environment with higher interest rates, higher inflation. Stocks will struggle, especially tech stocks. But if you own these names and you own them for a time when inflation comes down, at a time when interest rates will begin to come down again, that's when you're going to be rewarded. So the individual investor needs to have some patience, need to be resilient, which we all are. We always seem to climb that wall of worry. If we can stay patient and buy good quality, even though today it's all about the macro, it won't always be that way. And eventually, we'll get back to analyzing individual companies again on their own merit to see how good they are. And that's when you're going to see some of these good quality names move higher once again. So Canadian GDP, as I mentioned, I guess on the first slide, topic I wanted to discuss, surprised everybody, I think, for the last quarter of last year was pretty much flat. And actually, the month of December, we saw a negative number. We think the January number, which we should get results shortly, is trending slightly positive. But the Bank of Canada told us not too long ago that he would not, he meaning Tiff Macklin, said that the Bank of Canada wouldn't be surprised if we maybe even went into a slight recession, meaning growth went negative for the first couple of quarters of this year. And we're starting to see a bit of that right now. We have a nice chart which shows Canadian GDP and how it's flatlined over the last quarter of last year. And there it is. You saw a lower growth number as we moved into COVID and COVID lockdown. And as we came out of COVID lockdown 2020-21, things shot up and then flatlined the last couple of years. I think the main takeaway from this chart and this idea is how are the markets going to react? Is good news bad news, or is bad news good news? So the fact that we see very little GDP, is this good news to the Bank of Canada? Because they're saying, well, GDP or growth is stagnant. Inflation should start to or continue to come down. And that's what the Bank of Canada wants. We're also seeing GDP in the US come down as well. And again, that's music to the Fed's ears because they're saying that if we can get growth to come down, inflation will follow at some point later on. So what may be bad news in terms of growth or GDP for our country is good news on the inflation front. So I wanted to bring up that point that when you hear that our country may be struggling with growth, not to worry so much because it's anticipated by the Bank of Canada. It should be anticipated by all of you and should not affect your investment decisions going forward. Our banks, I talk to a lot of people and no matter who you seem to talk to, nobody feels sorry for our banks. They make billions of dollars every quarter. They charge fees for, certain types of accounts. So that if your account goes into a negative balance, you get hit with a cost. If you want to have some checks produced, there's a fee for that. There are a lot of fees that the banks charge. So I don't think anybody feels bad when they hear that, one of our major banks didn't make as much money this quarter as they made that last quarter. But one of the main ways or most important ways that our banks make money, our banks, banks in the US, banks around the world, is through net interest margin. Now, what is net interest margin? Simply put, net interest margin is basically the money that a bank makes, and it's the difference between what a bank pays out on the money they have sitting in savings. So if you put money with a bank savings account, what interest rate are they paying you? Are they paying you 1%, 0.5%, etc.? And it's the difference between that and what they charge you for the loans they provide. So if you have a mortgage, are they charging you 5.5%, 6.5%? And the spread between the two is called net interest margin. And we have a chart about this that we can show. And I think it's the most powerful chart in our show today. And it clearly shows the difference between what a bank is paying and what they're charging. And you can clearly see here, if you take a look at, for example, TD Bank, they're charging on their 5-year fixed mortgage rates 5.5%, but they're only paying 0.5% on interest savings accounts. They're charging 6.5% on variable rate mortgages, but they're only giving you 0.5 point for money you have in a savings account. Scroll down, you see other banks are paying a little bit higher. It looks like the highest one is BMO paying 1.8%, but again, on a variable rate mortgage, you're looking at 6.5% interest. So you can see how much money the banks are making in net interest margin. Now, when interest rates go higher, we always like to say banks make more money, and it is true because of this reason. Unfortunately for the banks, they lose out in a lot of other areas. Perhaps people aren't as quick to take out loans when they're paying 6.5% interest. Perhaps trading is not going as well. Wealth management division, managing money, managing portfolios. Portfolios may fall when interest rates are rising, when the stock market is falling. So banks, they charge a flat fee for certain types of accounts that they manage. So obviously, if those portfolios, the value of those portfolios is falling, then they're not making as much money in wealth management fees. So they don't make money in every aspect when interest rates go higher. But you can clearly see by the chart we had up that these banks, top 5 largest, smaller banks, banks in Europe, banks in the United States, everybody makes the same profit based on what they pay and what they charge. And that spread is called net interest margin. So I thought it was quite interesting that everybody understand that the banks are doing just fine. They may not be increasing profitability when times are tough and the economy is not doing as well, but they're doing all right, I can safely say. And yes, I know most people will say I don't feel bad for them, and I don't either. But at the end of the day, the best way, in my opinion, to profit from how the banks are profiting from us is owning a bank stock. Why not own stock in a large bank here in Canada, such as Scotiabank making 6% dividends just for owning the stock, or CIBC, or TD that pays well over 4%. How can you make back some of the money we're paying the banks? Own the banks. So you share in their profitability. And I think that is a better way to look at it than just sitting back and saying these banks are making way too much money. So recently, China has set lower growth targets. And it was, again, something that I found interesting. Many found surprising because we're used to China growing at a rate of, well, let's say north of 7%. For many years, they grew double digits, 9% growth. I think those times when were more when China was considered more of an emerging market. I know China still gets lumped in as part of the emerging markets, but I don't think of China as an emerging market any longer. China is the second largest economy in the world and growing quite a bit over the years. So when they say that they're going to grow at 5%, I know that both Canada and the US would love to have a 5% growth rate. But for China, it's a bit of a slowdown and a bit of a disappointment. So how does that affect the stock market? Well, it affects things such as oil, commodities in general, metals, because China is a very large importer of energy, of metals, materials, commodities in general. And so if the country is not growing as quickly as anticipated or as it once was, they don't need as much oil. They don't need as much energy. So what happens to the price of oil? Well, it falls. And very interesting, I've mentioned this on other shows before, when Russia invaded Ukraine, I believe it was Russia's intention, or what they thought was going to happen, was that the price of oil and natural gas would spike. And it did for a short period of time. But what they didn't anticipate was COVID and COVID lockdowns in China and COVID zero policies in China, because that's what has kept, in my opinion, the price of oil from rising significantly over the past few years. China policy, COVID over there, growth rates in China. They've had a tremendous impact on the price of oil. And because of oil being today roughly $75, $80 a barrel, instead of what many anticipated would be well over 100 by now, it's helped to keep inflation down. Yes, keep inflation down. Remember, inflation in Canada was over 8%. Inflation in the US was over 9%. Now inflation is 5.9 in Canada and 6.4 in the US. And in my opinion, a lot of that reduction in inflation has come because oil prices have dropped. The price we're paying at the pumps has gone down. Price of commodities, certain materials has come down. Lumber, natural gas is at multi-decade lows. We were fearful of a chaos in Europe based on natural gas prices. And what has happened? Nothing. So I think we have a chart. I think we had a chart on the China. Bring back that chart. And you can see how, if you compare China to previous years, you can see that other than 2020, where we had COVID hit, and 2022, when they had their zero COVID policy, you're looking at one of the slowest growth rates we've seen in a while. And what it's going to do is it's going to keep, or hopefully help keep, inflation in check, and hopefully help keep interest rates from really going sky high, which is good for us. But if you're someone investing in oil and commodities, you have to be mindful of what's going on in China, because they are the biggest importer of those things, and they definitely affect the price of these things going forward, which will obviously affect the stock price of the companies that are in that sector. So does it pay to diversify in today's market? And a client of mine brought this topic up to me this past week, last week actually, and said, you know what, Allan, you built me this great diversified portfolio, yet when the market goes down, I seem to go down anyways. And I thought that was an interesting question, because I think she had it wrong slightly, in that when you have a diversified portfolio, it doesn't mean that your portfolio can't go down. In fact, it actually can. And what we're seeing over the past year or so, the market tends to go down kind of in an all or none response. So either all goes down, or it all goes up, or it stays flat. A lot of the days, or many of the days, come and go where we see that type of scenario. 500 stocks in the S&P, 495 go down, for only 5 go higher. Yes, whether you own a diversified portfolio or one stock, chances are you're going to fall. The value of your portfolio will come down. However, what diversification does do is it limits that fall. So perhaps if you had maybe 30 stocks in the S&P 500 go down, and you only own 1 or 2 stocks in your portfolio, and they happen to be part of that 30 that went down, you're going down. But what if you own 20 different stocks in your portfolio, and 2 were part of the 30 that went down, but the other 28 went higher? Then on that day, it definitely paid to be diversified. And so what I tell individual investors is, by diversifying, you can limit the losses on the downside. Sometimes it limits the upside. Yes, if anyone is thinking that, that is true, but it definitely will limit the downside. And on days where the S&P 500, and I use the S&P as I always do because it is the largest index of 500 stocks in North America, if 495 stocks go higher, you're probably going to go higher whether you're diversified or have 1 or 2 names. So Diversification helps by protecting you on the downside. So owning a diversified portfolio doesn't mean you're not going to fall in value of the value of your portfolio won't fall. It means that it will lessen the blow. It will allow for growth on days where part of the market struggles and part of the market can actually go higher. Diversification is the key. It is free and it is the best way to protect your portfolio in any scenario, in any market environment going forward. So what's my take? That's the part of the show where I answer some of the questions that individual investors may have. I always try to get in 2 or 3 if I can. I know we're getting close to the end of the show. So let's start with one here. Is there a certain sector of the market that is good to be investing in right now? Where do you see good value? I like that question. I guess the best way to answer it is, to me, I'm even though I always talk about the macro, I did on this show today, I'm actually a bottom-up stock picker if we're talking about stocks, for example. So I would say that I don't necessarily focus on one area. In previous shows, I've said technology seemed cheap, and it does, and it still is cheap. Technology was the most beaten up area last year, so it makes sense that coming into this year, we've seen the most bargains in the tech space. But make no mistake about it, there are bargains right across the board in many different sectors, many different areas. So if I had to choose, I guess, one sector right now, it would be technology. But there is good value in many different places, whether it's bank, whether it's retail, pharmaceutical. Pharmaceutical actually had a good year last year. This year, struggling a little bit, but there are still names, even in the pharma space in the US, that I think you could buy today. Good quality companies, Eli Lilly, Merck. Eli Lilly a little on the expensive side, Merck a little more on the cheaper side. In the tech space, as I've mentioned many times, if you can handle the risk, the volatility that a name like an Amazon or Google brings, I think those are pretty cheap, even Meta or Facebook. So there are a lot of areas that I think you can look at, different sectors of the market. So not just one area. Another question here, what is a RIF and how is it related to an RSP? So a pretty basic question. Think of a RIF as a mature RRSP. When someone turns 72, their RRSP, Registered Retirement Savings Plan, needs to be converted to a registered income fund. It has to be converted RSP to a RIF. And simply put, a RIF is now where you start to draw money from, money that you need to live off of in retirement. Let's say you're retired by 72. But you can change your RSP to a RIF anytime if you want and start drawing money anytime if you want. Always keep in mind that any money you draw from a RRSP or the RIF counts as income in the year that you pull it out. So just be mindful of that. Lastly, let's try and get squeeze one more in here. Now that the RSP season is over, what is the next vehicle to invest in and what is the deadline? So there really is no, I guess, other investment vehicle. I guess if you're looking at different types of accounts, tax-free savings accounts pop into my head. There really is no timeline for that, because if you don't invest in a TFSA or tax-free savings account this year, your room gets carried forward to the next year. But if you had to say a timeline or envision a timeline, it's calendar year. Whereas RRSPs, you can invest till March 1st of the next year if you want to be eligible for a tax deduction. For, let's say, for example, 2022, it was March 1st, a couple of days ago. For tax-free savings accounts, it's December 31st. And then you get a new $6,500 the following year, or a new allotment that you could add. So no real deadline, no real new vehicle. Vehicles are there. They should be used. I love tax-free savings accounts, especially now that the amounts have increased. So I'd like to thank everyone for joining me on the show today and taking time out of your busy day. Hopefully I was able to give you some knowledge, arm you with some information that you didn't have before. And I guess our next show will be March the 22nd, which is, as always, a Wednesday at 12 noon. Until then, good luck and happy investing.